How to draft the price escalation claim in construction loans. This is today's topic. First, understand what a price escalation claim really is. People, general audience, think that it is an attempt to make additional profit, which is not so. It is a claim for additional cost incurred due to abnormal increase in the input prices beyond what was considered at the time of tender stage. So price escalation generally relates to materials like steel, cements, bitumen, copper, fuel prices, energy, labor wages, imported components that affects due to exchange rates. The government imposed taxes or duties. So a valid escalation claim proves that first, the increase in cost was unforeseeable or abnormal. The risk was not allocated to the contract. The increase caused actual additional cost. The cost increase directly affected the work. Identify the contractual basis first, whether your contract has the provision for the price escalation claim, or find the provision which might be useful for the price escalation. Sometimes it may not be direct. So check whether the contract clause includes a price adjustment clause. Most contracts have this. The contracts that heavily depend on a particular metal or a particular cement or steel. It depends if such projects have a price escalation clause, and they even have a cost fluctuation formula. Sometimes it goes up, even sometimes it goes down. Then you can check for a change in law clause. Then going to the force majeure or the exceptional event clause, the hardship or economic equilibrium clause. This is under Indian jurisdiction. They used to say that economic duress. So a clause stating fixed price with no escalation. So what is the key drafting rule? If the contract is silent on escalation, so that's where most contracts, bespoke contracts, they are silent. Your claim must be framed under either change in law, variation due to statutory change, prevention principle, employer risk events, doctrine of frustration or hardship. It depends on the jurisdiction. Your claim title must match the clause relied upon. So define the trigger event and notify it very early. So you must clearly define what caused the escalation, when it occurred, why it was beyond the normal market fluctuation, why it was not under your contingency of fluctuation you have considered during the time of bidding. So what are the examples of valid triggers? So sudden government bans on exports or imports, an introduction of new import duty, war or geopolitical disruptions, pandemic-related shutdowns, statutory wage revisions, abnormal fuel price hikes. So you should avoid these triggers like market conditions change, prices increased generally, inflation affected the project. No, these are not triggers for price escalation claims. Establish the baseline price. So what was the price that was considered at the time of bidding? So you can show your tender BOQ rates, vendor quotes at the tender stages, material rate build-ups, subcontract agreements, procurement schedules, pre-contract correspondence, if any, like emails, letters, whatever. So clearly state that the material or the what you are claiming for. You are claiming for the material or you are claiming for the labor. What is the unit rate at the tender, and what was the date of the tender, and what was the source dependent for this pricing. So without a clear baseline, escalation becomes speculative. Demonstrate the escalated price with evidence. So here comes the most important one. So what are the acceptable evidences? Usually when you go for a negotiation for price escalation. Supplier invoices, that it shows that that's your actual cost. You have already paid it. revised vendor quotations. So you are not able to pay because the initial quotation was very low and the new quotation is abnormally high. Purchase orders, wage notifications, fuel price indices, especially from the government authorities, custom duty notifications, government circulars or price indices for every year they used to release a new price indices. So what is the best practice is to show the tender price, revised price, what is the percentage increase, and what is the date of increase. So avoid averages or estimates unless permitted by the contract. Prove causation between escalation and the work. So a common reason for rejection in failure to prove that the escalated prices are where you actually paid. Is this related to the project? Where it is unavoidable, or is there any other mitigation effects that might have been taken? So you must show that what is the quantity, actual quantity procured, what is the date of procurement, and when it was consumed to the project. For example, you might have purchased a long bag, and you might have kept in the inventory, but you have not consumed for the site. The prices may go down in the later period. That also happens. So you should demonstrate the inability to mitigate. So explain why early procurement was not possible, alternative supplies were unavailable, and employer cost delays pushed the procurement into an escalated period. So procurement fall under the prolongation period or the extended period due to the employer. Calculate the escalation amount correctly. So sometimes most of the contracts which has the price escalation clause has the formula also. So this will be the very common simple formula. What is the actual price? What is the tender price? And what is the quantity consumed? That is going to be the new cost. Next is the formula based adjustments used where escalation formula is provided. Usually they depend on correct indices base date, correct weightages, correct calculation methods. When you use a change in law method, you have to go with the taxes, duties, wages law. So you have to claim only the incremental cost, the net increase, exclude the recoverable credits, never include overheads, profits, unless contractual allowed. Some contracts allow that you can go for the 10% or 15% cover up for the contractor, and if it doesn't allow, do not keep them. Inefficiency costs unless separately claimable. Address risk allocation explicitly. So you must be able to demonstrate that the risk of escalation was not allocated to the contractor. The escalation exceeded what a prudent contractor or experienced contractor could have foreseen. So use risk allocation classes, particular conditions, employer risk classes, exclusions in fixed price wordings. If the contract says fixed price, there is room for escalation, then you have to explain why this event falls outside the normal price risk and why the event was exceptional and unforeseen. This has to be demonstrated. It just can't be covered with the word that it's a fixed price and you are not able to claim it. The fixed price was based on the risk allocation foreseeability at the time of contract award. Comply with notices and time bar. This is very, very important, as I already said that. So ensure timely notice of escalation, refer to the correct clauses, ongoing updates where required. So you have to keep them informed always, be in communication with the employers, and the final claim must be submitted within the contractual timelines. If the notice is late, they explain the continuing class that the price escalation is being continued and we are procuring in batches. So that's why we are not able to submit the notices with a specific cost or time the submit the entire claim with a specific cost. So rely on waiver or prevention principle if applicable. So structure the claim. So how to structure the claim? So this is an example. So what are the headings you have to consider while structuring a price escalation plan. First is executive summary, then is the contractual basis, then description of the trigger event, baseline pricing evidence, escalated pricing evidence, causation and impact analysis, quantum calculations, contractual compliance, what is the relief sought, and what are the evidences in appendices and supporting documents. So the most important is the clarity, not the volume. The more number of pages in the claim, that doesn't mean it's a good claim. If you have good clarity, then the claim wins. So what are the common mistakes you should avoid? Claiming inflation without contractual basis, using market reports without linking to the project, claiming escalation or unused quantities, mixing escalation with delay damages. Both are different, including profits where prohibited. There are certain classes allow profits and certain classes doesn't allow profit. So you have to be very clear in that. So ignoring mitigation obligations. It is always the mandatory obligation of a contractor to mitigate the cost increase, the time increase, so whichever is possible by them. That is a final practical advice. So always keep the price escalation claim to contract driven, evidence heavy, not on a hypothetical basis. Keep the calculations transparent, legally disciplined writing, commercially balanced writing. So always draft escalation claims as if they will be tested in the arbitration or the litigation tribunal at the last, even if we expect a settlement immediately. So always build your claim for the last resort you always seek. Thanks for watching. If you want to know about any particular topics, do comment on it. And if you need any consulting on the price escalation claim, please contact the below numbers. And if you are an individual, if you want to have a cut through in your career, in your performance, then do take your master diploma courses to see the change in career path. Thank you. Thanks a lot.